as you know, we like to dig into our risk metrics, review all of those, and then dig into a bunch of the different economic data and points we're looking at to help inform our thesis around what we're seeing out there in the world, and what's happening, and then how we should be positioning portfolios in response. So let's jump right in.
Let's jump right in.
Yep. So the yield curve.
So we've been talking about this for those of you, we see some new people in here, but we've been talking about the importance of a yield curve now for quite some time. The slope of the yield curve is generally a very good prediction of direction for the economy. If you would allow me to show a screen, I want to show something that I have. Hopefully I have it here.
Yeah, you should be able to share screen.
Okay, let me see if I could do that. Share screen. This will stop the other share screen. Do you want to continue? I'm going to just show that just for a second. Okay. All right. So let me just get to this. Can you see that, Paul? Can you see the,
Yep.
Okay. So, what this chart shows you is it shows you the probability of a recession. And typically what you see, this shows that there's an inverted yield curve. Right here, when it starts to tick up, that's an inverted yield curve. And then the gray line shows a recession. So you can see as we have this inversion, a recession comes. You can see it starts an inversion here, a recession comes. It starts an inversion here, a recession comes. It starts an inversion. So the inversions happen before a recession comes. That's what this chart shows you. Can you see that clearly, Paul? Is there anything that I'm missing there for everyone to see? An inversion happens? Okay.
Pretty straightforward. And if you look too, you can see that the recession doesn't happen immediately after the inversion. I think on average, it's 12 months after.
Yes. Now we are well into 12 months of an inversion of our yield curve because it's been going for about 14, 15 months now. And you can see it's very unusual. You can see that we're constantly ticking up, and it's very unusual to actually see a downturn, like a change in the yield curve before there's a recession, right? You can see this here. It goes up, recession. It goes up, recession. There's none of this downdraft. So this might be why you're seeing some confusion on Wall Street. Recession, no recession. We've been talking about recession for a very long period of time. And if you look back in 2022, the official definition of a recession is 2 negative quarters of GDP. My brain is, because I've been gaslit now, my brain is forgetting it. Is it 2 or 3 quarters, Paul?
The old definition used to be 2.
2, thank you. But they changed that definition in 2022. So my entire 37 years at that time, the definition was 2 quarters of negative GDP. They never declared a recession then. And what Paul and I always speak to is maybe there's no recession for you and me. But there is a recession for the bottom half of the United States, for anybody below middle income. Anybody below middle income, absolutely there's a recession because their money isn't going farther. So I just wanted to show you the importance of the yield curve here, which is why Paul always pulls that data in every month, because this generally, as you can see since the 60s, has been a great indicator of recession.
Okay, we have lots of charts and data that we'll look at today that really solidify that point.
Yeah. Okay. I'm out now. Your turn.
Yeah, here we go. All right. So back to the yield curve, right? Now, what is a yield curve inversion? Just that the short end of the curve, meaning bonds that mature 1 month, 3 months, 6 months, 1 year, 2 year, are yielding more than bonds that mature 10, 20, 30 years out. And this chart shows the 1 month, 2 month on the left and the 20-year, 30-year on the right. And so when the curve inverts, it means that lower end is going up, higher, yielding more than the longer end. And this is the yield curve inversion. What that's saying is that there's a lot more uncertainty or concern about future growth. And so people are sort of piling onto the short-term side.
Now, one of the things, sorry, Paul, don't mean to go, but one of the things that you can see here is that the red line shows you where we were 1 year ago, and it showed an inversion a year ago. But you're just starting to hear conversations now about the Fed potentially lowering rates. About If you saw, I think it was the beginning of December, maybe beginning of mid-November, when the head of the Federal Reserve came out and said that there's going to be 3 rate decreases in 2024. Now, I can tell you in my 8 years now, I have never seen a statement like that when the rest of the Fed governors are not on board. So what we've seen over the last few weeks is some, what would you say, conflict within the Fed governors saying, some are saying, well, no, it won't be until the 3rd quarter of next year, maybe. So the question is whether this was political posturing. This is the truth. This is what Paul and I are questioning in our work. Now, the yield curve would speak to the fact that we are in a recession and that rates should come down, or that we're heading in that direction. However, inflation still is sticky. They can say what they want. And Paul and I will show you some charts to that later. Okay. So there is a general consensus on Wall Street that they're lowering. Paul and I are not necessarily in that general consensus for a number of reasons, which we will share with you.
Exactly.
Yeah. We
All
think
right.
that is in the pickle. All right. Keep going, Paul.
All right. On spreads, we touch on this pretty much every time we meet. These have been contracting or tightening. When you see these things blow out, or the spread here really increase, that's a sign of risk. Why? Because you have to pay more for a corporate bond as opposed to a government bond. And when you need to pay more, why? Because it's more risky. So when these spreads tighten, it's saying that, okay, maybe there's less risk between the government and corporations at this time. So this is an interesting metric going on right now because it has been trending tighter and tighter and tighter. And so this is saying that there's probably less stress, or what would you say, Alexander? Overall risk?
Less stress in the finance.
Yeah.
Less stress on the balance sheet. Now, this is important because generally this number cannot be played around with. Now, one of the things that is happening right now is we don't have a lot of inventory. So when there's less supply, right? There's less supply, then the prices are going to go higher. And this may be showing that, meaning there's less companies actually issuing debt than before. Most of the debt that's taking place right now is in the federal government, not in private, corporations. So the question is if they're tightening because there's not a lot of supply. Something is off here, in my opinion. It's definitely showing there's no risk. If we were to just look at this for what it is, it's showing there's no risk on the balance sheets. Now, maybe that's the case. So we don't think this is the case in banks, but this is what this is showing, and this is the data. So we have to go with what we have here.
Well said. All right.
Paul and I always look at alternative hypothesis to what we see. So we're always trying to keep a check on each other. Like, is this what we're truly seeing? Is there an alternative hypothesis? Are we wrong? Because this is what you want us to figure out. Like, are we wrong in our direction? So
one of the interesting data points for bond spreads too that we've come across, still need to do, I'd say, a lot more research on this, but there is the growth of private debt markets that has increased exponentially from where it was even 5 years ago. And so the question is, are private debt markets really obscuring or obfuscating some of the risk that should be showing up at these spreads? Because now it's moved to a private, non-transparent market.
Perfect. I love that Paul brought this up. So I'm going to break this down for you. So there's three ways that corporations can fund their operation. One, they can issue corporate bonds to the market, which is what you see here. Okay, so people like us would buy it for you. That's one way. Another way is they can go to private equity and they can raise money there. And this is what Paul is speaking to, is that they are beginning to fund more with private equity, which would not be a transparent market. It would be opaque. Okay, so the question is, and this is what we do follow, is what's happening in private equity. And we did see last year that there was some, especially in commercial real estate, there was some more, and you're probably reaching that to your headline, there's more delinquencies in commercial real estate. So we would stay away from that market, meaning offices and retail and such like that. So that is something that has changed over the last 5 years. This has been a tried and true indicator for me since the 80s. Now it may not be as tried and true as it used to be because we have that market that's not opaque. The third way that a company can make a third way that companies raise funds is through a private through doing a loan with a bank, which is why Paul and I watch senior loan surveys with banks to see if they're tightening or loosening. Hopefully that makes sense to everyone. If not, ask something in the Q&A. That's fine. Okay, so we can do that. Okay. All right.
Oh, next slide is, there we go. Credit default swap spreads. This is just a measure of insurance on a company going bankrupt. And these have generally been flat to tightening over the past year or so. Now, normally you see these things sort of spike when the risk of default increases. And what this is looking at now, grain of salt here, this is looking at things in aggregate. So some of the outliers aren't going to show up on these kinds of charts, but on average, we're looking at investment grade bonds as a whole. How are the credit default swaps doing? Investment grade, high yield, and emerging markets. And on average, in general, they are coming down, saying that the risk of default across these sort of broad aggregates has shrunk.
Yeah, and I just want to correct one thing. It's not investment grade high yield. It's high yield junk, basically. So we look at all layers. So we're looking at investment grade, high yield, emerging markets. Yeah. This is what we're looking at. So this is where we are. Now, this is interesting. So this is something we talked about in the financial crisis, that during the financial crisis, a lot of the debt that was on the balance sheet at corporations were transferred to the US government and the taxpayer, the governments around the globe, not just here, really in the developed world. What this is showing, which I find interesting, and this is a hypothesis we had after the financial crisis, if we're taking debt off the balance sheet of a corporation and putting it onto the US government balance sheet, we're increasing the risk on the US Treasury. And that's what this shows, actually.
Right. Institutions can buy credit default swaps on governments, and that's what this is. This is the U.S. government sovereign CDS spread. So you can find these for all different kinds of countries. Historically, the U.S. has been quite low, considering it's the reserve currency. They call it the risk-free rate, all that kind of stuff. But as you can see, really since 21, I mean, it's been on a steady uphill trajectory. I mean, these are levels that were last seen during the great financial crisis in 2008.
Yeah, you know what, next month, what we'll do is we should pull in, Paul, some of the sovereigns from other countries so that we can compare it. Because I do think that our spike is greater than the spikes in other sovereign debts. The interesting thing is, if you look at the emerging markets, and we find this really intriguing right now, you are not seeing a spike. Now, remember, this measures risk. This is insurance, right? The more risk you have, the higher your insurance premium. Okay, so what we're seeing in the emerging markets is we're not seeing spikes like this in the emerging markets. We're seeing that here, and we're seeing it more in Europe and more in the developed world. So next month, Paul, let's put that on the roster.
Yeah, we can do a whole bunch of countries. That's great. Yeah. I was looking at a few earlier too, and countries like Germany are lower than the U.S. So
yeah, and that's considered good debt.
Through this chart in there, I thought this was highly interesting. It was just comparing long-term treasuries total return subtracted from the total return of gold. And for what, 40 years or so, it's been negative. And for the first time in 45 years, it's just moved positive, saying that treasuries, US Treasury bonds, are now more volatile than gold.
Yeah. Just... So now, wow. And so we've been getting, the reason we put this in is we're getting a lot of questions around gold as a reserve. Okay. Now, Paul and I, you know, we have a theory, which we've been following for 10 years. I've been longer than that eventually the dollar will not be the reserve currency, that there will be a basket or there will be something else that comes in. Now, what this chart shows, what did we go into the gold? What did we go out of the gold reserve? What, Paul, in the late 70s, right? Yeah. Was it late 70s? And so this is interesting that since the dollar became the reserve currency, it was from the 70s onward, we've been, you know, we've been less volatile. Now it's the complete opposite. And we find this interesting because at this time, countries around the globe are buying gold in spades.
Mhm.
China, Brazil, even in Europe, US. Many of the Fed reserves around the world, they're buying gold. The central banks are buying gold. So, and that's been going on for a while. That's been going on for at least 10 years since the financial crisis. 15. Right. Oh my God, 15 years. Wow.
Already.
It
Wow.
goes so fast.
Time flies.
It feels like now.
All right.
Okay. Go ahead. You want to talk about this?
Yeah, sure. So we've been tracking this very closely for the past several months around money market flows, because this is really, I guess, a proxy for us to determine health of banks, right? Because when you have your reserves at banks, your savings accounts, all these things, that's the money that the banks use to then create loans, that small businesses use, medium businesses use to fund expansion, to hire more employees, to grow more, right? But when you start taking those reserves away, i.e., moving them to money market funds, because that's what is happening in these charts. You can see the massive inflows into money market flows that have happened. I mean, they're at records. Where does all that capital that was previously used to fund small business growth, where did it go? Right, it's gone. So it's just one way for us to say, okay, are these regional, smaller, mid-sized banks healthy? Are they in a good position? Has anything changed since all those banks failed last year around this time?
Yeah. So Paul Smith,
no.
Silicon Valley Bank, Sovereign Bank, and this is really Sterling Bank. Now, this is important because what this shows is disintermediation from banks, meaning money is coming out of the savings account and going into money markets. And why not? We're getting higher yields. Okay, so this makes sense. Like, as an investor, you want to get a higher yield. You're not getting a high enough yield in the banks. But the problem with this, with disintermediation, and this is actually what happened with Silicon Valley Bank, is there was a run on the bank, so to speak. Money was coming out of the deposits and going elsewhere. Okay, so that led to the collapse, and it happened very quickly with their balance sheet being repriced, and we can go on. However, you have to remember the engine to our economy is that investment, is the investment from the banks. That's why Paul and I watch the senior loan survey, because we need to make sure that they're still giving loans to small companies. And you will find that that is drying up for the smaller companies. And this is why Paul and I believe that small caps, despite what we hear from other people, will underperform this year. Because there's a tightening in credit still. And this definitely speaks to that.
Mm-hmm.
All right, go ahead, Paul.
Yeah, so this is the BTFP. This is one of the windows that the Fed put in place to try to help, right? So we have all this money flowing out of banks and into these money market funds, and it puts these banks in a tough position because they're not liquid, or a lot of the treasuries that they bought over the past decade are super low yielding, and so they need a way to essentially make up for the liquidity. So the Fed created this program to sort of stopgap some of that. What we would want to see is the usage of this start to turn downward and be used less, because that would say banks don't need the liquidity as much as they thought. All is good. But instead, even last week, we just printed a new record high in the usage of this facility.
And so this was put in place. Go ahead. Sorry.
No, go ahead. Go ahead.
This was put in place after Silicon Valley Bank, for the banks to come and be able to borrow and lend overnight. Now, this is a problem, in our opinion, because, first of all, it's not talked about. No one's talking about this. And that bothers me, because it's like shoved away. And like, of course, Paul and I pay attention to these things along with SOFR and a lot of other things. But this isn't speaking to the health of banks. And that's why we don't like these smaller banks, unless there's certain ones. And if you're in a bank, keep it under 250,000 and make sure you know what their balance sheet looks like. Yep. Have a conversation. So if you're in a credit union, for example, see what their balance sheet looks like, or any bank if you can. So again, keep it below the 250. if this changed in another direction, then we'd be less inclined to say there's a problem brewing, but something's going on that's not being talked about. So, and I want to assure you something. Oh, one thing. They didn't talk about much during the financial crisis, before the financial crisis. They started talking about subprime, and they were pretending it didn't go to prime. But they never talked about prime. So I just want you to know, like, this is why we watch these numbers. I don't care. We do not care what the talking heads say. We do not listen to the television. In fact, we barely ever listen to any of the analysts in this industry, if we're honest. We just want to look at data because it's unadulterated.
Yep. Yep.
There's no agenda. We have no agenda to pretend.
Right. It says, here's the data, and this is what it's showing, and it's telling a story. So this is the overnight reverse repurchase agreements, another Fed window that they use to help provide liquidity. I don't want to get too far into the weeds on this because there's actually a lot going on between two and arbitrage between some things that might be happening. What's important is that on the right side of this, you see it going down, being less and less and less. The way to look at it in this time frame is that this is another way to sort of fill liquidity or provide liquidity for banks. And sort of the blue bars represent how much is available at this overnight window that the Fed has. And so the fact that it's coming down and down and down and down, while the Fed usage of the other window is going up and up and up and up, are hinting at, or at least pointing us to start thinking, okay, is there a serious liquidity problem that's happening here? So something to pay attention to and keep an eye on. What happens when this goes to zero?
Yeah, it doesn't mean okay, just understand, this isn't like you pay us to pay attention to these things, and what we're showing you is just a fraction of what we look at, just like literally a fraction. So we can go on, but all right, next.
We'll jump to the economic data. It's already 2:30, so.
Oops.
All right.
Let's.
Leading economic indicators, right? Our index, we go over this. If it's below that little red below that little red line, historically, it's always signaled a recession, at least according to the Conference Board, the people who do this survey. It's still down there. U.S. continues to signal recession. Here are the different components.
And again, Paul speaks to it, but again, it depends where you are. Our seniors who are on fixed incomes, they're in a recession. I mean, when you look at like what happened with retail sales over Christmas, it was buy now, pay later. No, this is not a sign of a good time. Yeah. So, all right, go ahead, Paul.
And you can see too the components of the leading economic index. Almost everything is pointing to the left here, right? It's a detractor, it's negative, with the major positive just being the stock market. And so that's not a sign of, hey, the economy's great, everybody's doing well. Well, one piece of it happens to be doing okay right now, while things like the non-financial components are actually doing pretty horrible.
Yeah.
And we'll dig into some of these numbers.
Yeah, and this is like, we love to look at the breakdown of everything, because again, the leading, you're going to read the headline, oh, the leading economic indicators are so good or whatever, they're positive. Well, really, when you break it down, this speaks to the health of the economy. Building permits, if they're not happening, building permits are what, it gives me an idea of how much people are going to spend on a washer, dryer, to put into that home that they're building. So average hourly work week, it talks to the health of a company and how much they need overtime and so on. All right, so we keep going. Let's keep going.
We could go on and on about this one. Thought this chart was interesting. It just shows sort of how headline numbers are presented. The DPI is disposable personal income of a person, so it's sort of like that after tax. I think it's after tax.
It is after tax.
Purchase, how much dollars you have left. And it's presented in this way of like, oh, wages have been growing, people are being hired, employment's really low. But when you factor in inflation, all the other expenses in the real world, you actually get this sort of average hourly earnings of how it actually feels. So this chart it's a very stark contrast between what's being presented as, oh, this is all good. But then when you actually look at, well, what is the real down to earth experienced experience of the individual, it's much closer to the how it feels line.
Yeah. Actually, if you all would do us a favor and raise your hand, you don't have to speak or anything like, just raise your hand in the chat box if you are feeling it's more like how it feels or how it's presented. So if it feels like more how it feels, raise your hand. Don't raise your hand if it's how it is presented. I'd be very curious just from a survey. Oh yeah, we have lots of people raising their hand.
Next time we've got there's a poll option, and we should put some polls out there for our next call.
Yeah, let's do that because the bottom line is, you guys, you know, there's what Paul and I say, it's like a form of gaslighting. When you read the headlines, what they're saying, what the reality is are really two different things. So, all right, so let's keep.
Household savings have been negative, meaning the blue line here going negative means that month over month people are spending more or saving less or taking from their savings. And that excess savings amount that peaked at 2.3 trillion right after COVID hit is already down to 1 trillion. So you can see this trend is just continuing and more expensive. I mean, look at this, right? This is the inflation data that we like to look at because it's arguably a more accurate measure of the lived experience than what the headline numbers are. So headline inflation is what, around 4%. Using the methodology, how they calculated it back in the 1990s, which is probably more accurate. It's saying inflation is really closer to 8% currently. And remember, they're talking about disinflation. And so, yes, this number is coming down, but it's still higher than it was before. So if inflation was this, going up, and now inflation's this, you're still paying more and prices are still going up for everything, just not as much, but it still means it's harder to pay for things.
Yeah, your baseline is higher, right? Rarely do you ever really see them lower costs, right? So your baseline is higher. Here's where it went. It stayed there and we're still going up, but the rate of change is lower. The rate of change, right? So we're down. And something that's really important, and the reason we wanted to show inflation, and again, those of you who follow us know, we have a thesis that inflation is going higher for necessities: food, health insurance, car insurance, home insurance, energy. Okay, this is what we're, somebody coming to fix something in your home, if you can find a handy person to do that for you. The costs are going higher, and there's only so much the Fed can affect that because they're necessities, they're baselines. The other thing that we want to point out, which makes us cautious, and we haven't even really begun to see what's happening here, but what's going on in the Red Sea, what's going on overseas around shipments, this is affecting supply. This is affecting supply because we are a very import dependent country right now. So
we've got some great charts that show that too, I think.
Oh, cool. Go ahead. So I'll shut up now.
We'll get there. We'll get there.
Okay. All right.
Yeah, unemployment, same thing. Yes, the headline numbers have been saying, oh, record low unemployment. Sounds great. But is it really a true measure of what the lived experience of the average person is out there? I mean, the way that they calculate this number is if you stop looking for work, but still are unemployed after 6 months, you're no longer counted. So even though you are unemployed and don't have a job, if you haven't found one in 6 months, then you're not counted as, then it's not captured in this. So real number, according to Shadow Stats, how they tackle it is closer to 25, which I don't know if anyone's been out there driving during the middle of the day, but I find traffic everywhere. I'm always like, who are all these people?
So I think we should move forward a little bit and summarize, Paul, because we're getting like.
We'll do this part quick. This graph just shows the top 10% hold 92% of equities. So keep that in mind too when we're talking about, or you hear people talking about, oh, the stock market's great, everything's great. It's great for the top 10%.
Yeah.
Government expenditures, I wanted to throw this slide in.
Yeah,
You can
this
see
is
this
really
average,
important.
right?
Mhm.
Yeah, go ahead. You had a great point on this earlier when we were
Yeah,
talking.
yeah. I mean, this is thank you for pulling this in, Paul. You know, we're like when people are talking about the economy doing better and so on, the reason being is the government is making up for what individuals are not spending. You can see we have like really obviously post-COVID and during COVID, the government took over, but that has not stopped. And you can tell clearly by our debt load right now is at a record. And this is making up for what's not happening in the private sector right now. And this is where the jobs are being created, in fact. So
Yep. Home sales are at levels last seen during great financial crisis. Just interesting data. Empire manufacturing hit a record low print.
well,
This is just, well, I mean,
other
COVID
than
was
COVID.
a lot went on then, right? If
Yeah,
you
yeah, the
COVID out of
shutdown.
the equation, it's a
Yeah.
pretty bleak picture for manufacturing. ISM,
And
this is
we
services.
really like Empire manufacturing. Like there's so many, just so you know, like there's several measures that we like, there's the Philadelphia Fed, there's tons of measures that we can look at for manufacturing, but Empire manufacturing really gives a nice overview of what's happening throughout the economy, manufacturing through the US. It's been a really good predictor.
Definitely agree. Here's ISM. It just shows that the services, so manufacturing, right, coming down, and then the other side, services, also trending down. Concerning global shipping, which Alexander was talking about earlier, this is the cost of containers, so shipping containers, since the Suez Canal has gone vertical.
Yeah.
We're going to pay for that. I mean, this is an inflationary metric here. I mean, these costs will get passed on, or are being passed on.
So I think we should just leave it there and summarize, Paul, because we can go to, I think we're getting really late in the game. So let's just summarize here how we're positioning so everyone knows, right? You good, or is there something else you want to know? Okay.
Yeah. We'll close that out. Screen share
Okay.
stopped.
So,
All right.
so how do we position in such a thing? So one of the things that you have to know is if inflation is going higher, which it is, it bumps up the earnings for many companies. So like you see in the insurance industry right now, for example, really good earnings, okay? The big companies benefit from this, which is why Paul and I are focusing our work in mostly the larger companies. We have a saying here, we're going for the bugs, we have a whole acronym for it. So the big companies the big companies benefit from this because they do have pricing power. And there's just been so much consolidation over these last several years that's created a lot of pricing power in certain companies. It makes us not favor small cap. Unlike a lot of what we're hearing from a lot of other analysts, they were talking about small cap being something they're looking at. We're not going to play in the small cap area because of what we're showing you in the financial sector, in the balance sheets and happening at the banks. So that makes us focus in the direction of the market, of the larger companies. And then, Paul, there's a question about extending maturities.
Yes, we get this question a lot around, does it make sense? Because if the Fed was to cut rates, then the price of longer dated bond or duration would go up. It's an inverse relationship. So if the Fed is going to cut rates drastically, you would want to buy longer dated bonds because the prices of those should appreciate because of that. We are not so certain that that's happening.
Suspicious.
Yeah, suspicious,
We're not
to say
so
the least.
sure. Yeah.
So I see a question in the chat here of, do we think Fed's going to cut rates sooner rather than later? No, is our answer to that. Higher for longer, most likely. As Alexander mentioned, one of the Fed chairs recently mentioned if they were going to cut rates, it wouldn't be the third quarter. Even that might be too soon. I don't think we'd see rates cut unless it was purely politically driven, or there was some unforeseen crisis or something that happens to pop up that nobody anticipated.
And I'm just going to say this because we've said this before, Paul, that the Fed was raising rates I think, pretty quickly and pretty intensely. And, you know, do they want to break the system? Paul and I talked about that. Do we think that we're on a razor's edge? Yes, to a certain degree. There's stuff going on that it's concerning. And this is why we always say things are not what they seem. This is why we don't pay attention to the news, except for the things that we absolutely need to read. We have some really great services we use, but we're so data driven. So if we were to just simply look at the data, we would say that we're on a razor's edge, and that again, if you look at the certain socioeconomic status, they already are in a recession. They're already there. Will lowering interest rates help them? Doubt it. Doubt
Right.
it.
And the other thing to remember too is when the Fed is cutting rates, it's not like, oh, great, cheap money, jubilee, markets go wild. Really, what it's saying is that the future expectation of growth is lower, right? So you cut rates and try to bring them down to try to change that. So it's not necessarily this great thing, rates being cut. And when you look historically over the past, I think there's thousands of years of history around generally what interest rates should be. And it shakes out to around 5%, sort of where we're at today. So we're kind of like back to this long-term average. We'll see.
Yeah. And I mean, do Paul and I want to extend our maturities at this time? No, not yet. Maybe down the pipe, but not yet. And it isn't, let us be clear, it isn't because we think it's a great economy. It's not. It's just that the indicators aren't showing yet that it's time. And it namely has to do with inflation. Yeah. So, any other questions? Let's see what we got here.
There was one question that came in around positioning for the 24 election, and given the current political environment, what are our thoughts on that? And to that, I think we agree mostly. While politics in the news is hyped up to play a much, I think, bigger role than it actually does in markets. Generally, if it's a locked election, or if you have one side win the presidency and the other side split or win the House, or so that it's split, that indecisive or that sort of gridlock, markets really like historically. So.
Yeah, and I mean, somebody asked the question because we said, do we think we're on the razor's edge? Look at, here's what we know. And here's what I know, just having done this for a long time. Things can, obviously we're invested in the large cap companies right now. Our job, well, we think we're on a razor's edge. Our job is to continue to pay attention to the data and make changes if the changes need to be made. Not before, not as best as we can preempt what we see. We think we're positioned well. We're staying very short on in bonds. We do have what we call some barbell. So we did extend just a tiny bit, which we did mostly through, I would say, closed-end funds, Paul, right? Mostly.
Yeah.
Right?
Yeah. And even a lot of those are on the shorter end too.
Yeah, and we make sure we have the, the below NAV and everything else. But at this point, we think we're conservatively invested, yet invested in the right places, because one of the things that we see as we turn this new year, like around November, when Paulson made the announcement that they were going to lower rates 3 or 4 times in 2024. Right. I mean, like, hello. We started to see a broadening in the market, meaning there was more participation. So there's 500 stocks in the S&P 500. Throughout the majority of 2023, it was in like what, Paul, only like 10 of the 500 companies were basically going higher until November, when it started broadening. Now, one of the things that Paul and I said is we have to wait until January to see if that broadening continues. Because normally January is when small caps start to continue to have their outperformance. Well, that is not happening. I don't know what's so magical about turning a new year, but anyway, as we turn the new year, it's just the way it is in the industry. As we turn the new year, that broadening stopped, which continues to tell us that staying in the larger names is the best way to go.
Yes.
So, okay, do we think we're on a razor's edge? Look at, I called the razor's edge. Some of you are with me who were in the financial crisis 2 years before it happened, okay? It can correct itself. I have times like the Asian contagion in 1998. There was a razor's edge, but it corrected itself. It did correct itself. So it didn't really have like show of problem until 2000. Anyway, so that's what I have to say there.
All right.
Any other questions?
Thanks. All right. All right. Other countries, where are we looking?
Yeah, I mean, we love India. What can we say? We think they're gonna be a winner here in for a number of reasons. The demographics.
The demographics for India are fantastic. There's lots of positive, right? Lots of positive tailwinds behind India that look really appealing.
But this is it safer countries because they're less political. Look, I think no one in this room is going to say things are less political right now anywhere in the world. Okay, I just don't. I do think that's the externality that's probably, in my opinion, and Paul, you can. It's the biggest issue we have, right? So yeah, I would say. I mean, it's a little frightening to me.
Yeah, it's a very interesting time. I mean, geopolitics now, we're entering a very interesting time in history. The sort of pendulum is swinging from one side to the other. And we all get to live through it. So
yeah. And then the one last thing is somebody was asking about, is this recording going to be available? We have a whole compliance thing we have to go through here. So we get it available as soon as we can. So it's not like we can send it to you tomorrow. We just can't. We have to have it, scripted, approved, and so on. So then once it's available, we'll certainly send it to you, but you are more than welcome to invite anybody to come and listen to us, please, anytime. But in terms of being able to have the script ready for you, we can't until we go through our compliance process.
All right. So if any other questions pop up, or you're curious to pick our brains, feel free to give us a call, shoot us an email. We are available and really enjoy this stuff.
Somebody said something about Mexico's new plans for shipping. So, no, I'm
not sure. I mean, there's a lot of onshoring going on into Mexico. Many factories are being built there. This kind of stuff takes several years really to work out, but
yeah, we do have clients who are in manufacturing who moved a lot of their operations to Mexico, but they've been doing that for a number of years.
Yeah,
out of China and out of Taiwan, because they were anticipating, as we were, some issues in that particular area. I think that's the last of our questions. I know there's more. So if you want to call us, please feel free. We're edging up in that hour and we don't really want to go too far with this from here. Okay.
Awesome.
So thank you all for joining us. And if you need anything, you know where to find us. Give us a ring, send us an email, and we're happy to help you through.
Okay? All right. Thank you, everyone. Take care.
Be well.